The Women WHO, Banked in Shadows, Industrial England's Invisible Financial System Act 1. The Paradox of Powerless Wealth Creators in 1850s Manchester, England. Textile mills produced wealth on an unprecedented scale. Cotton goods generated fortunes. Factory owners built mansions. The British Empire's industrial dominance rested on textile manufacturing. The workers who actually produced this wealth, primarily women and children, lived in overcrowded tenements, worked 14-hour days, and earned wages that barely covered food and rent. But the economic marginalization went deeper than low wages. Under English common law doctrine of coverture, married women had no legal economic existence. Their wages legally belonged to their husbands. They couldn't own property. They couldn't enter contracts. They couldn't open bank accounts. Single women had slightly more legal capacity, but practical barriers remained enormous. Banks required substantial minimum deposits far beyond what working women could accumulate. Banking hours coincided with factory shifts, making access physically impossible. Bank managers viewed working-class women as unsuitable clients and denied them service. This created an extraordinary situation. Women were the primary workforce of Britain's most profitable industry, but they were systematically excluded from the financial infrastructure that served that industry. The solution emerged not from reform or legal change, but from necessity. Women created their own financial system, informal, illegal, and extraordinarily sophisticated. Act 2. The architecture of the box. The basic unit was deceptively simple, a wooden box with a lock, kept by a trusted woman in the neighborhood. The box woman. Women workers would deposit small amounts, often just pennies, weekly or daily. The box woman recorded deposits in a ledger. When a depositor needed money, she could withdraw her balance, often with small interest earned from the collective fund. This sounds primitive, but the system was far more sophisticated than it appears. The box woman wasn't just storing money. She was operating a bank, taking deposits, paying interest, making loans, managing risk, and providing financial services to a community excluded from formal finance. The social architecture was crucial. The box woman was typically an older woman with established community reputation. She often worked from her home, conducting business that looked like social visiting. Deposits and withdrawals happened during conversations over tea. This camouflage was essential. The system operated in legal gray area, not explicitly illegal, but vulnerable to interference from authorities or husbands who might claim legal right to confiscate funds. The trust mechanisms were sophisticated. Reputation replaced collateral. Community knowledge replaced credit checks. Social pressure replaced legal enforcement. If a woman borrowed from the collective fund and didn't repay, she faced social consequences that were often more powerful than legal penalties. She'd be excluded from future access, marked as untrustworthy, potentially ostracized from community networks that provided crucial support. This created strong incentive structures. Default rates were remarkably low, often lower than formal banks, because the social cost was so high. Act 3. From survival to system. By the 1860s-70s, these informal banking networks had evolved beyond simple savings clubs. Some box women were managing substantial capital pools, hundreds or even thousands of pounds accumulated from small deposits by numerous women. This capital enabled lending for purposes beyond emergency relief. Women borrowed to start small businesses, taking in laundry, selling goods at market, opening small shops. The informal banking system provided startup capital that formal banks would never consider. They borrowed to avoid predatory lending. Talon credit, where merchants sold goods on credit at extortionate interest rates, was common in working-class neighborhoods. The informal banking system offered alternatives with reasonable interest rates. They borrowed to maintain respectability during crises. When a woman's husband died or was injured and couldn't work, she could borrow to maintain rent payments and avoid the workhouse while finding alternative income. The system stabilized working-class neighborhoods in ways formal finance never could. Banks wouldn't lend small amounts for short periods at reasonable rates. They had no interest in the financial lives of working-class women. But those financial lives required services, emergency funds, short-term credit, small business capital, savings mechanisms. The informal banking system provided all of it. The scale was significant. In industrial cities like Manchester, Birmingham, and Leeds, these networks likely served tens of thousands of women. The collective capital pool was substantial, probably millions of pounds circulating outside formal banking channels. Act 4. The innovation of risk management. The most sophisticated box women developed lending practices that anticipated modern microfinance by over a century. They diversified risk by lending small amounts to many borrowers rather than large amounts to few. If one borrower defaulted, it didn't collapse the system. They created graduated lending. New members borrowed small amounts initially, building trust and track record before accessing larger loans. This is identical to modern microfinance progressive lending models. They used group lending mechanisms. Women would form small borrowing circles where members guaranteed each other's loans. If one defaulted, the group covered it. This created peer monitoring and mutual support that reduced default risk. They adjusted interest rates based on risk assessment. Established members with strong repayment history received lower rates. Newer members or those borrowing for riskier purposes paid slightly higher rates. None of this was formalized or written down as policy. It emerged through practice, refined through experience, and transmitted through apprenticeship as younger women learned from established box women. But the sophistication was remarkable. These were working-class women, often with limited formal education, operating banks with risk management practices that rivaled or exceeded formal institutions. Act 5. Survival in the shadows. The system's illegality was both its greatest vulnerability and, paradoxically, a source of resilience. Because it operated informally, it was flexible. No regulations constrained lending practices. No bureaucracy slowed decision-making. The box woman could assess a request and provide funds same day, impossible in formal banking. But the vulnerability was constant. Under coverture law, husbands had legal claim to their wife's property. A husband could demand access to his wife's savings in the box, and the box woman had no legal grounds to refuse. This happened. Court records occasionally reference cases where men sued to access funds held by box women, claiming legal right to their wives' money. Sometimes they won. To mitigate this risk, women developed camouflage techniques. Deposits were recorded in code or hidden within household accounting. The box itself might be disguised or kept in locations husbands wouldn't access, sewn into mattresses, buried in gardens, hidden in chimney spaces. Some women deposited under false names or used intermediaries, creating layers of deniability if authorities or husbands investigated. The most sophisticated networks created distributed storage. No single box held large amounts. Funds were spread across multiple box women, reducing the risk that discovery of one box would collapse the entire system. This constant threat of legal intervention created what modern organizational theory would call antifragile systems. Because they couldn't rely on legal protection, they developed resilience through decentralization and redundancy. Act 6. Outperforming the legitimate. Here's what's remarkable. During the financial panics of the 19th century, informal, women's banking networks often proved more stable than formal banks. The Panic of 1866 saw the collapse of Overend, Gurney and Company, one of Britain's largest banks. The failure triggered widespread panic. Multiple banks suspended withdrawals. Credit markets froze. But the informal women's banking networks largely survived. Why? First, they held actual deposits, real money in boxes, rather than operating on fractional reserve principles, where banks lent out most deposits and relied on confidence to prevent simultaneous withdrawal demands. Second, their lending was conservative. They made small loans to borrowers they knew personally who had strong social incentives to repay. Default rates were low even during economic distress. Third, their depositors had limited alternatives. Working-class women couldn't access formal banks anyway, so panic-driven bank runs didn't affect the boxes. Fourth, the social trust that underpinned the system proved more durable than financial confidence. When formal banks failed, people lost faith in financial institutions. But when your box woman had been managing your savings reliably for years, and you knew her personally, and she lived in your neighborhood, that trust persisted. This pattern repeated through subsequent financial crises. Formal institutions wobbled or collapsed. Informal women's networks largely continued functioning. There should have been evidence that the system worked, that these women had developed effective financial practices, that exclusion from formal finance was unjustified. But because the system was informal and largely undocumented, its success remained invisible to policymakers and economists. Act 7. The slow recognition. By the late 19th century, social reformers began documenting working-class financial practices. Some recognized the sophistication of women's informal banking networks. Beatrice Potter later Webb, investigating working-class life in London in the 1880s, documented women's savings clubs and neighborhood credit associations. She recognized them as functional financial institutions serving needs formal banks ignored. But the typical response from reform-minded observers was that these systems should be replaced with formal alternatives: government-sponsored savings banks, cooperative credit societies, regulated lending institutions. The assumption was that informal systems were primitive substitutes that should be superseded by modern formal institutions. This missed the point. The informal systems weren't primitive, they were adapted to specific needs and constraints. They provided services formal institutions couldn't or wouldn't provide. They operated with flexibility, speed, and social knowledge that formal bureaucracies couldn't replicate. Nevertheless, the early 20th century saw gradual expansion of formal financial services to working-class populations. Postal savings banks, cooperative societies, building societies all provided alternatives to the informal systems. Legal changes also mattered. The Married Women's Property Acts 1870-1882 gradually gave married women legal economic existence. They could own property, enter contracts, control their wages, at least in theory. These changes didn't eliminate informal women's banking networks, but they reduced their necessity. Women who could now legally access formal banking sometimes shifted to formal institutions, but many didn't. The informal systems continued operating well into the 20th century, particularly in communities where formal banking remained inaccessible or unwelcoming. Act 8. The legacy in modern microfinance. In 1976, Muhammad Yunus founded Grameen Bank in Bangladesh, pioneering modern microfinance. The model was revolutionary: small loans to poor women, based on social trust rather than collateral, using group lending and progressive credit to manage risk. Yunus won the Nobel Peace Prize in 2006 for this innovation. But every element of the Grameen model, group lending, progressive credit, social trust replacing collateral, focus on women borrowers, existed in the informal banking systems created by British industrial women a century earlier. The Victorian box women had invented microfinance. They just didn't formalize it, document it, or get credit for it. Modern microfinance has become a global industry, serving hundreds of millions of people. It's recognized as crucial infrastructure for economic development in the global south. But its origins lie in the shadowy financial systems created by working-class women to survive in an economy that legally excluded them. This history matters for several reasons. First, it challenges narratives about financial innovation coming from formal institutions or elite innovators. The most important innovations often come from margins, from people excluded from existing systems who create alternatives. Second, it reveals that informal doesn't mean unsophisticated. The informal banking networks were highly sophisticated, often outperforming formal alternatives. Informality was adaptation to legal constraints, not primitive development stage. Third, it shows that financial exclusion creates innovation. When people are denied access to existing systems, they build new ones. Those new systems often serve needs the formal systems ignore. The pattern still visible in 2026. Informal financial systems still exist in communities excluded from formal banking. Immigrant communities operate rotating savings and credit associations (ROSCAs), essentially the same box system Victorian women used. Members contribute regularly, and funds rotate to different members on schedule. Unbanked populations use check cashing services, payday lenders, and informal money transfer networks, expensive and sometimes predatory, but filling gaps formal banks leave. Cryptocurrency advocates argue Bitcoin and other digital currencies enable financial participation outside formal banking, though in practice, crypto has replicated many exclusions of traditional finance. The fundamental dynamic persists. Formal financial systems exclude populations based on income, geography, legal status, or other factors. Excluded populations create informal alternatives. The alternatives often work well for their users but remain legally precarious and invisible to policy. The Victorian women's banking networks teach that these informal systems aren't just stopgaps waiting for formal inclusion. They're sophisticated adaptations that often serve needs formal systems can't address. The box women proved that financial services don't require marble buildings, regulatory frameworks, or formal credentials. They require trust, community knowledge, and commitment to serving actual needs. Those women, operating illegally from kitchen tables and basement workshops, created financial infrastructure that sustained the industrial working class through the most volatile economic period in modern history. They did it without recognition, without legal protection, often without literacy or formal education. They did it because they had to, because formal systems failed them, because their communities needed financial services and no one else would provide them. And the system they built worked. It worked so well that its basic principles now underpin a global microfinance industry, serving hundreds of millions of people. The women who created it never received credit. Their names are mostly lost. Their ledgers were destroyed or discarded. Their boxes were thrown away. But their innovation persists. Every time someone accesses microfinance, they're using a system Victorian textile workers invented out of necessity in the shadows of the Industrial Revolution. The women who banked in shadows built the foundation. We just forgot to acknowledge it.